put your money in this trust and you never pay taxes again. That went around big last year. I was taken out of the IRC, Internal Revenue Code 653. This is a scam.
Hey guys, so I'm excited to welcome to another episode of the Practical Wealth Show. I have Mr. Matthew Pearson. So we're going to talk about taxes, but in a good way, how to minimize your current and future taxation, okay, which your mind should be on. So let me tell you a little bit about Matthew, and then I'll let him tell you a little bit more about himself, which he can do better than me. But Matthew is a creative-driven visionary who began his career really as a executive director of a Christian camp in the recreation industry, and feeling a deep calling to serve entrepreneurs. He launched a business coaching firm that quickly grew into one of the nation's leading top resources, guiding more than 40 business owners each week. His passion for building ethical transformational relationships and his curiosity about smarter tax and financial strategies eventually led him to, and this is where our partnership come in, because I'm associated with that, led him to co-found Advisors Excel, now one of the most influential firms in the financial services industry in the area of tax strategy. Okay. And so Matthew, welcome to the show.
It's great to be here, Curtis, sorry.
That's all right. So call me if you call me late for dinner, right? So
I'm always excited to talk about taxes. I know it's not the most interesting topic, but you know, we all have to deal with it. So
fix my mic here. So yes, but you know, so let's talk about why I always tell people so most people give most of their money away, right? And a wealth transfer is money leaving your checking account and with regard to taxes and going to the Treasury Department's checking account. Okay. Yeah. But if you pay a tax you didn't have to pay, then not only have you given away that money, this is what people don't do, Matthew, is they don't account for opportunity costs and that money Absolutely. At interest over time. Absolutely. And so that's what I specialize in. I want to show people how to keep more of what they make and make more on what they keep. But many families think their biggest expense is housing or food. But if I know it's taxes, right? Why are taxes the single largest wealth transfer families face, in your opinion?
Because it's like anything else. If you're not planning on it, it's like the monster in the corner that keeps growing. Nobody wants to talk about it. Number one, most people will defer. I've had people that I've worked with that say they won't even go get the mail because they're afraid there's going to be a letter in there from the IRS. Yeah. So from the wealth transfer, everybody focuses so much on the offensive side of things. I've got this stock portfolio, my pie chart looks really good. I'm up 12% this year, and that's all great. But what most people don't understand is there's something eating at that. And the longer that you leave it in that tax bucket, say, for example, your retirement account, the bigger the chunk is going to be. And so the sooner that you take care of that, you can reduce or mitigate most of it. But again, most people don't stop to think about that. It's like, well, it's not that big a deal. And I think especially for individuals who get that W-2, we work with people that, make $400,000 or $500,000 a year. And it's like, well, I don't really see my taxes coming out. They don't take a look at their pay stub anymore. Like, used to. I mean, and Curtis, you're not this old, but I'm that old. When I got paid every week, I had a pay stub, and it would tell me what my taxes were taken out.
I am that old.
People don't look at that. Yeah. And, over time, that is a significant amount out of your paycheck. And there are things that even high W-2 earners can do to mitigate, or not 100% eliminate, but mitigate bulk of that. And then it just carries over. It's not just your W-2 taxes. It's your retirement taxes. Most people, since the 80s and the excitement that got behind 401ks and things like that. And if you're a business owner, maybe some of the other more strategic qualified funds for business owners, they see it this year that, oh, wow, I saved because I maxed out my 401k. That mindset is totally wrong because you're deferring it. You're kicking the can.
And so here's a better word for defer: postpone.
Oh, they're going to pay it, and it's going to be greater in the future.
Yes.
So again, absolutely, I would rather pay taxes on the seed if I was going to pay taxes.
Yeah.
Now, one of the things we do at Excel Empire, we help people reduce those taxes. But if I was going to pay, I'd rather pay on the seed than the harvest. But again, conventional wisdom, common sense that you get from most CPAs are going to be like, oh, it looks like you're going to pay X amount in taxes this year. Why don't we max out a 401k, and that's going to reduce your taxes? What you should hear when they say that, why don't we max out your taxes for the future? And that mindset would change what people would actually be putting their money towards.
Because I always ask people, do you think in the future will taxes be higher, lower, or the same? Right? And they always say higher. Well, but you'll hear from, I remember, because I used to be like a typical max out your 401k, buy, term investor difference, mutual funds are a great sense of sliced bread advisor. And we used to say, look, you're going to be a lower tax bracket when you retire. No, you're not. Only way you're in a lower tax bracket is if you're poor or poorer.
Yeah, do you want to be poorer in retirement?
Right. And you're paying for that advice. So you're trying to be poorer, right? We want you to have money in a tax problem. So what are I get two questions. All right. So first of all, this might lead into the second one. I'm gonna do this one first. What are the common mistakes you see? Let's talk about business owners and families make when it comes to overpaying their taxes.
Yeah. So let's start with business owners. We've been in this business since 2003. I've been a certified tax master. You name it. We own multiple accounting firms. And the thing we see from a business owner's standpoint, they don't realize the importance of keeping their books. So what you have is you have a great secretary. You started your business. You got a secretary. She's running your calendar and everything. And all of a sudden, it's getting to the place that you're like, wow, I need to get something. So they go out and they buy QuickBooks, and they send that person to a 3-hour, 4-hour training, and that person is starting to run their books. As the business grows, that person never knows anymore. So if they start off doing things wrong as your business grows, you're going to be paying more taxes because they're making mistakes, but the numbers are bigger. Right. We find, and this number is actually backed up by the General Accounting Office of the United States government, 21% of businesses overpaying in taxes is because they've got the wrong person doing their books. So, that's the biggest mistake I find. Or, I have this all the time. I always tell business owners, we're going to fire your spouse. Because number one, their spouse is getting stuck doing the books and they really don't know anything about it. But, the business owner doesn't want anybody else to know about their numbers or have access to their banks.
Right.
That spouse, it's like anything else. I don't like to play golf, Curtis.
Right.
So guess what? I'm not really that good. Same thing if your spouse really doesn't like doing accounting and stuff like that, or doesn't have a background in it, they're not going to be any good. So first of all, make sure you get the right people doing your books. Make sure you're getting classifications. And probably the biggest thing I find too, and I can give you a great example of this, is the wrong entity. We find this all the time. Business owner decides they're going to go into business. It's not a big business or it's a side hustle. So they just start out, it's an LLC because everybody told them it was an LLC. What they don't understand is that means nothing to the IRS or the federal government. It's a state designation. You're going to pay taxes at the highest rate if you have an LLC and it's on your 1040. As that business grows, I've worked with people making $10 million a year in their businesses on their Schedule C.
Ouch.
We can come in and save them literally millions of
dollars.
dollars.
Like $1.5 million of Because of the self-employment tax, because their thing is set up wrong. Oh my God.
They've got a great business. They got a great business mind,
Yeah.
but they just never went back and revisited that. And so the next problem I find is they'll go to their attorney or they'll go to their CPA and say, hey, I want to start a business. I want it to be an LLC. And their CPA will just set them up as an S Corp. And, that causes problem. I'll give you a real life example. I was speaking to a group of dentists that bought another practice. And the first thing that their CPA told them, it says, well, it's an antiquated C Corp. We should switch this to an S Corp. It's much more efficient. And in most cases, I would be 100% in agreement with that. But what you need somebody to take a look at that, a professional to take a look at that, and not just give you it's because this is more effective. But in this particular case, there was hundreds of thousands of dollars in that C Corp for carry forward losses. They would have lost $128,000 worth of actual dollars had they followed that CPA's advice.
Wow.
So that's number one for business owners, is that what type of entity and then how are you doing the books? I always tell people the most important person you have on your team is your HR and your bookkeeper, not your CPA. Your CPA at the end of the year gets that proverbial shoebox. Today it comes on a flash drive or through a secure portal. But they don't take a look at your numbers. They take the numbers out of your QuickBooks and they just punch it through a software. It puts the right numbers in the right boxes so you can be compliant. Your biggest line of defense is that bookkeeper. So you got to have a great bookkeeper. On the W-2 side of things, the biggest mistake that I see today is you've got somebody making $400,000 or $500,000 married, filing jointly, or you got a doc that's making even more of that. The first thing they decide to do is, I'm going to get into real estate. What they don't understand is, in order to get the greatest deductions off of that, they have to participate in something called material participation.
Yep.
So they go out and they buy 2 or 3 homes and they think everything's going to be good. And they find out from the depreciation side of things, because they don't have material participation, the IRS comes back and declines all of that amount of depreciation because they don't have enough. They're not a professional. And what we find is that individual maybe doesn't have, it's around 14 hours a week.
Wow.
That they have to be involved in that real estate. So that's a big thing that I find. And a lot of times they don't run into that because the IRS does audits random. So you may be into it 2 or 3 years, and then the IRS comes back and says, yeah, we're going to decline all that because you can't prove that you're spending 14 and a half hours a week in that. And so that material participation is really big. So there are other businesses that you can start as a W-2 individual that only have 100 hours material participation. So now we're talking about a long weekend.
Right. So. You actually help one of my clients, so we're Matt and I are partners. So you got to kind of come through me to get to them, but we helped a doctor client of mine do that.
Yeah.
And I won't get into the specifics because, but she was high income W-2 and we set it up. They had to do the 100 hours and go to Missouri and do some other stuff, but we're walking them through all of that stuff. So you know what, why, where, and it's covered. So if somebody comes looking, you've got all the I's dotted and the T's crossed. That's what's important.
Absolutely. That documentation, and that's really what the IRS is looking for.
Right.
On some of those material participations. They're wanting to see, is this legit? Are you legitimately running a business, or is this a hobby, or is this just I'm running this just to use depreciation, but I really don't qualify for it. So yeah, that's very important. To make sure that you're working with professionals, because the opportunity for both W-2 and business owners, it's wide open. There's so many strategies, but they just don't know what to take advantage of. And quite frankly, we've worked with over 3,000 CPAs, and I remember a CPA bringing me a client, and the client looks at the CPA and he says, why didn't you do this for me? And I will never forget the response of the CPA. The reason I don't do tax planning, this was his exact words. The reason I don't do tax planning is because if I did this for you, I would have to do it for the rest of my clients.
Yes. So that brings me to my other question. So I want to talk about reactive versus proactive tax strategy. Because see, people think that they're getting, oh, I have a CPA or I have a whatever. They think they're getting tax strategy, maybe a little bit, but they're really getting more tax preparation, maybe some bookkeeping at a higher than, I won't even tell you the price I was quoted. They had a CPA do my books. I was like, no, thank you. Right. So talk about, because that's the big thing. I was watching one of your presentations. I don't know if this fits here. Is it green light, red light?
Red light, green light accountant.
Yeah. Can you explain your thought process and methodology around that?
Absolutely. So the AICPA, which is the American Association of CPAs across the country, have done a great job of promoting CPAs as tax professionals. And remember that tax is not even in their name. It's a certified public accountant. The vast majority got a certified public accountant because they are going to account for income and expenses. Now, what I'm going to tell you is there are CPAs out there that have been self-taught, and most of them like this. Their client comes to them and says, hey, I just bought a $150,000 pickup truck. Can I use that to reduce my taxes? CPA goes, yeah, we can do that. But the CPA is reactive when you come and bring them the question. Yes. Or at the end of the year, you say, wow, I'm going to pay a lot in taxes. Is there anything I can do? And if your CPA tells you, is there anything that you could buy to depreciate? That is a reactive CPA. Yeah. They should be bringing ideas to you. As a matter of fact, one of the questions that we have found be very effective, and it really is a transformative question, is when was the last time your CPA came to you and said, hey, I've got an idea that will save you money? That is the difference between a reactive, you ask them questions, and a proactive.
And I would say most of y'all got reactive advisors, right? Because nobody's ever asked me that, and because I'm like, wait a minute, what am I paying you for? Because I'm reading books, I'm reading Sandy Bakken, I'm tax-free, Tom Wheelwright, and I'm like, can we do this? Can we do that? It's all, I had to tell them to switch me from a C LLC to an S election. I had to bring that up because I'm like, what is this self-employment tax thing? And then being the nerd that I am, I figured it out. So can we do this? Oh yeah.
It's not the CPA's fault though. Let's be honest. Like I said, the AICPA.
I'm not throwing them under the bus. Sorry.
They've done it. Most CPAs are doing exactly what you're paying them to do. Yeah. They're keeping you compliant with the IRS. They do a great job of putting right numbers, right boxes, right time. And there are some out there that are very, very proactive. There are those people out there, but you have to put yourself in the mindset of most CPAs. They go to work in January till April 30th. They work 100 hours a week, and they're not taking Saturday and Sunday off. Most CPAs are working through the weekend. They don't have time at that point to look at each individual client. Yes. And again, I put most of the earnest on the client because 60% of most CPAs' jobs is getting the documents, pulling the documents away from you, and you're waiting to the last minute to getting the documents. Right. So they're just trying to make sure they hit that deadline for you. They don't have time to be proactive. So again, I don't blame the accountant as much as you would blame, say the actual business owner or the W-2 individual, because they should be proactive. They should be getting those documents together, and then so that they can have conversations before the end of the year. Right. But again, I really think accountants, you're getting that service that they're good at giving. I always tell people probably the most expensive 6 words in the English language. When you ask somebody, so what are you doing to mitigate the taxes on the sale of that $1 million building? My accountant takes care of that. Ouch. Yeah. You're making an assumption, and the average accountant, this is not every accountant, so you might have an anomaly. The average accountant will sell one $1 million business over the course of their entire career. So that would be like, you know, you're walking down the road and you see a car sitting alongside the road. You go up and somebody's having a baby. You know, hey, I've watched what happens on television. I'm the only person that's here. I'll do what I can.
Right.
But in essence, you don't have a lot of experience, but you're the person that they're going to trust at the time because you're the only person around. At Excel Empire, we do 40 to 60 million in business transitions each and every month.
Wow.
So we have a specialized team. They've seen everything. They're there to help you go through that process. And I think that's a big difference between what that CPA is used to doing and accustomed to doing, and some of those things that you run into that are a little outside of the norm for them.
Can you share maybe one of your favorite examples of a strategy that most business owners miss that could make a huge difference if applied?
Absolutely. Yeah. I find this, and this goes back to your point. You're definitely not your typical financial advisor, anyways. This goes back to your point on the self-employment tax. I get a guy and a husband and a wife, and the wife's running a business, and the husband, you know, he's helping on the side, so they're both getting $100,000 salary out of the business. And my first question is, why are you paying both people a salary? Well, A, I want to make sure my husband gets paid, or B, I want my husband to be continuing able to be participating in an IRA or Social Security. They don't understand that 15% principle, you know, or that self-employment tax. We're going to fire one of you, and you're going to become a passive owner of that company. I don't need to give you a salary, but by becoming passive, I get much more favorable tax treatment. And again, that passive ownership is a better way to take those taxes. And as far as the Social Security question, I've always asked people, you know, the largest Social Security I checked is seen is a little over $3,000. If you're going to pay somebody in your family $100,000 a year, and they're going to pay into Social Security, could you do better investing that money than the government? Hey, kudos to the government. I mean, man, they know how to take in a lot of money, but I don't know that they're really good at investing your money.
Yes, exactly.
I don't know. I'm not going to.
Yeah, I mean, even without investing, I teach people you need to save 15-20% first. You know, safe, liquid, accessible guarantee. If you did that, you could probably do some stuff with it that could give you that $3,000 a month.
Yeah, pay yourself first. Absolutely, pay your future self first.
Yeah, pay your future self first. And so let's talk about. You talk a lot about building ethical, transformational relationship. How does this apply to taxes, where people often feel confused, overwhelmed, or distrustful?
Oh, and rightly so. We have people on our team that are constantly doing due diligence on different types of strategies. Mm-hmm. We probably hear of a new strategy every 2 or 3 weeks, and we go through the due diligence. I will guarantee about 90% of them don't pass the IRS due diligence. So what happens is there's a lot of scams out there. Yeah. You know, put your money in this trust and you never pay taxes again. That went around big last year. I was taken out of the IRC, Internal Revenue Code 653, and the IRS put out notices. This is a scam. That's not the way this is defined. But yet I still run into people every day, not every day, but on a regular basis says, hey, I just got told that we should do this. Have you ever looked at it? I'm like, yeah, if anybody tells you you can put your money in a trust and not pay any taxes, that, you know, go ahead and see what you look like in orange. I myself, I don't look good in orange.
And they want to put their business in a trust. Like I said, look, y'all can't let TikTok be your financial advisor, you know, or Instagram, because you see these little clips and it's like, you know, you just don't know what you don't know. I mean, yes.
Oh,
give me another one.
I got an incredible story about that one. Back before COVID, There was a guy that graduated college, went through law school, et cetera, went back in and bought a firm out in Napa Valley. His family was from Napa Valley. They were very into the Napa Valley culture, a bunch of wineries. So his estate planning firm went in and put all of the land of about 47 of the wineries in trust. It's great. Awesome idea. I thought the strategy was a great idea to put the land in the trust because they're looking at multi-generations. Some people have owned this property for 180 years. The only problem they didn't figure out was most of these people still take income off that property. So paying trust taxes is higher than paying their own taxes. So we picked up 47 wineries that year just by going in and creating a management company. So it managed the property. We took the owner's money out of it before the extra went into the trust, saving significant amount of money. But again, that's just an example of, is it a good idea if you own a winery to put the land in a trust? Most likely, yes. But again, your estate tax attorney is looking at estate taxes. That's great. You're going to pay that once.
Right.
Every year, you got to pay this thing called income tax. And if that's what you're getting your livelihood out of it, that has to be the primary focus. And the estate taxes obviously needs to be taken care of in those situations as well. But you can't do one and not consider the other.
Wow. So, that's powerful. So, I've been taught a concept. And so, Matthew, I try to position myself as what I call the macro manager. Like I'm the quarterback. I see everything. And people have these little, what I call micromanagers that are, I got an investment advisor here, I got a tax person here, I got a real estate person here, I got a banker here, but they aren't talking to each other
at all.
Okay, yeah. At all, right? And so who's coordinating that stuff? I try to be that person, but I always tell people, and this I think is where I love about our partnership is that I tell clients are the one piece of a bigger puzzle, right? But how should tax strategy fit inside? Or should it, because I could be asking a question wrong, all inside of an overall wealth building strategy? Because to me, it's like number one. So what do you think?
It is. A great coach, Bear Bryant, once said that offense sells tickets, but defense wins championships. I'm a big college football fan, and I can tell you over the past couple of years, Ohio State has put more offense players, highlight players into the NFL than just about any other program out there. But it wasn't until last year that something changed. They had defense. They won the championship with defense. Now, you could argue that for the 4 years before that, they're one of the top offenses in the entire college football program. But without defense, and that's the same thing with people and building wealth. Again, people focus on, my ROI, et cetera. But in any business, you got to think of cost of goods sold. Those taxes are going to come out. Yeah. You want to pay taxes on a big number or a small number? I'll give you just an example. Let's say that I owned a company and it was an Uber company, and I'm in a 10% tax bracket. So I'm not very successful. So I go to my my tax strategist and I say, hey, listen, I want to reduce my taxes this year. And you say, okay, go buy $100,000 Escalade. I know you can't buy an Escalade for $100,000. So you can't even buy a pickup truck for $100,000 today. But go buy that $100,000 Escalade. And everybody in their mind thinks, oh, I get to depreciate that. That is awesome. But it's based on your effective tax bracket. So you put $10,000 down and you get that's a complete wash. But stop and think about it. If I'm in a 37% tax bracket and I get $100,000 depreciation, I get $37,000 off. So again, there's this idea that, you do certain things, and this is a big, I call it upside down thinking, inverse thinking. You've probably got clients that have $1 million, $1.5 million in their 401k, and they're getting told by their CPA and everybody else, hey, let's wait till you go into retirement so that you're not making as much money, so we don't pay as much taxes. Think back to my little illustration there. We want to, if we're going to have to mitigate the taxes, I want to do that transfer of that 401k when you're in a higher tax bracket, because I get better boost or better energy out of that effective tax bracket while you're still working. And we run into that all the time. But my CPA said I should wait for a couple of years when I retire, and then I should reduce, take my qualified and move it to a Roth. You can do that, but if you're wanting to use a tax strategy to do it, let us use the higher tax brackets to help mitigate the taxes, because we can mitigate it at lower cost out of your pocket if you're in a higher tax bracket. That's totally contrary.
Right. Completely. Yep.
But that's the way the math works.
Yeah. I love that. I'm learning so much. I'll see you in Texas next month, by the way.
That'd be great. I'm excited.
Because I'm fascinated with all this stuff. So it's like, I don't want to do it. That's what I realized, but I like knowing it,
Mm-hmm.
And so they're actually really helping me understand it so I can better serve our clients. Because it's funny when you just say that. I always tell people Curtis is the defensive coordinator. I don't do offense. I don't do investments. I help you keep more of what you make through cash flow control, minimizing your wealth transfers, and helping you save what I keep you. Then your job is offense. Grow your business, buy real estate, buy whatever you like. Right. That's not my job. Investing is about becoming. I always tell people it's about becoming something, not about buying something.
Mm-hmm.
And so it's be, then do, then have. So you have to be fruitful and do multiply. Right. And then I talk about our three rules of investing: invest in what you know, or invest in knowing, invest in what you can control, and don't chase returns. Most people just chase returns, right? And so I'm trying to get because they don't, because Wall Street tells them you don't have the time, the 10-minute or training to personally manage your own money. I say 2 + 2 is 4, right? You just need somebody to simplify it for you, and then see everything, and build your team. It's like kind of like the family office. You got to have other people looking at your stuff other than you that know more than you, but you're still a captain of the ship.
Yeah. It's hard to find somebody that thinks like you, though, Curtis. Most financial advisors in this world today, they're going to share with their clients a nice little pie chart. And the argument there is, my pie chart looks better than your pie chart. Right. Or they have to say, my stocks are better than that person's stocks. We know that's not true, because stocks are stocks. And I did a study a while back, went back over the last 20 years, and I looked and thought, well, okay, what's the average returns for people that are working with high profile financial advisors? And the average return net of expenses, they're paying 1.5% to 2% to have somebody manage their money. They're getting 4.5% to 5.5%. So you think about it, and I'm like, well, I probably couldn't do any better. If they had taken their money and invested it only in the S&P 500, they would have been 12 to 14% every year and not had to pay anybody to manage it. But just like you were saying, nobody takes the time to educate themselves enough to feel comfortable to make those decisions. The stock market is tricky. I certainly would tell somebody, if you don't know, definitely go pay somebody to get that understanding. And if you feel more comfortable working with an advisor, there are great advisors out there. But if your advisor is not explaining to you, hey, there's multiple things, multiple asset classes that we need to invest in, because we don't want all of this to become a tax burden in the future. All they're really doing is they're 100% off. They don't even have defense on the team.
Right.
I told you I'm a football fanatic when it comes to a certain team in Ohio. Last year against Texas, and again this year against Texas, that game came down to goal line stances. Imagine if Ohio State didn't have the team on the field. I don't care how bad an offense or how good an offense Texas brought to the game. They're going to score an unlimited amount of points if there's no defense on the field. And again, I think that's the problem with most people when they look at a financial advisor. They want to talk about, like what you were saying, what's your average returns, what's your fees, how do you do something that's different than anybody else? And of course, they'll be like, I'm holistic. What you want. The real question I want to ask is, I want to know the different asset classes you're putting me in, and how does those relate to when I have to take money out, how I'm going to get hit with taxes. Because I'm of the opinion, I like stocks. I like life insurance. Life insurance comes with some very good tax benefits. But I would never tell anybody put all your money in life insurance or put all your money in real estate or put all your money in the stocks. You know, you're going to be better off being holistic and looking at ways to use some of these classes to avoid taxes in the future. And of course, the only way you can do that is by being diversified. And you hit the nail on the head just a moment ago. Nobody has the time to go out and find the best financial advisor, to go out and find the best tax strategist, to go out and find the best life insurance person. And then once you go out and do that, those people are not complementary.
Right.
They're fighting for the same pool of money. So again, if you can find an advisor that talks to you about different asset classes and how he can avoid, taxes, that's great. If you're talking to a financial advisor and you talk about how to avoid taxes and they say, during certain years, we can harvest loss. Put in your mind what that means. Because I lost you money and you paid me to lose money, you get to write that off.
Right.
So that's not a tax strategy. That's a failure.
And see, people let the tax tail wag the dog. When you go back to the car thing, right? People, I'll see people on Instagram. Oh yeah, I just bought $100,000 G-Wagon, and they think they can write off 100,000, but you just said they can write off 37, right? And so you can't let the tax tail wag the dog. But people will do that, and then they're selling you on getting business credit so you can finance their course and all this other dumb stuff, and you don't have a real business. Because I'm unwinding these things, where I'm looking at going through their cash flow and their financial statements, and you got all $100,000 worth of this credit this guru taught you into, but you didn't finish, and you don't have any revenue to pay for it, right? And you don't have any books, and you don't have any, it's a mess, right? So fortunately, I'm a nerd. So when who does that? Just sell a shameless plug, Curtis, and Practical Wealth. But I got.
Like I said, you're not the typical advisor. Again, most people are going to just take, hey, if you use me, I'm really great at picking good stock, and that's great if they're great at picking good stock. But my opinion has always been this: if I'm good at picking stock, I'm going to invest my own money the same way that I would do yours, and I would probably, after about the first 6 or 7 years, probably wouldn't need to still be in the business of using other people's money. I would be managing my own portfolio. But again, I think there are great advisors out there. There's certainly great people in the AUM space. But again, if you're going and you're going to look for somebody, my suggestion is make sure they have a team that doesn't just focus on putting money in the stock market. Same thing. I'm a big fan of real estate. I myself have what for me is a significant portfolio in real estate. It serves a purpose, but I certainly wouldn't go all in. I always liken those people that just go to one strategy or the other as lottery ticket buyers. If it hits, man, you're going to do really, really well. If it busts, if they don't call one of those numbers, you lost $2.
Right.
It's not a good plan. It's a nice wishful thinking.
Yes, I got my pistons of fire. I have all these questions. I'm going to be respectful of your time, but if someone wanted to take the first step towards reducing their tax burden from the business owner, and let's say with the consumer, I call it a cash earner, right? Where should they start? What should they start thinking about? What should they read? What?
Yeah. So we do have some books that are available. How to Beat the IRS Legally is a book that we did a few years ago. We've got another one coming out in October that's called Shift. So we have some books, but for me, the biggest thing to do, we here at Excel, we don't work directly with clients. Honestly, when you're selling free money from the government, we get a lot of people that are interested. The best thing to do is to reach out to you. We've got agents in different areas around the country. Like you're going to the Certified Tax and Business Advisor course in Dallas. You're going to be qualified to work with these people to find out which gate they need to go through. And then from there, you can introduce them to Excel at the right portal that's going to make the most sense for them. And so I strongly, and we're certainly not the only game in town. But if you find somebody out there that all they're going to do is like, oh yeah, we've got something that we can save you 35%. Here's this strategy. That's not a real good strategist. That's somebody that's selling a product. When you come through Excel Empire, go through Curtis. Curtis is going to do a deep dive and due diligence to finding out what your goals and ambitions, so that the tax dog doesn't wag the tail.
Right.
Okay. And we're going to piece you with the right portal here at Excel Empire, where we're going to align strategies with your goals and objectives, because certainly one size doesn't fit any. Strategies typically are multiple year strategies, because you might have 800,000 in your 401k. We don't want to move all of that in 1 year. We want to move that in 2 to 3 years.
Right.
But Curtis, you like me, we live lives. I've got our president of our company. He's got somebody that's getting married. And believe it or not, marriage, paying for weddings are not cheap anymore.
That's right.
And so, different things in life. It's not always, oh my goodness, somebody in my family got deathly ill. Sometimes it's the things that you want to celebrate, that you want to spend money on. So the strategies have to be dynamic. So don't just go out and buy an off-the-shelf strategy. Work with a group that is going to be dynamic in the planning. And again, like I said, we're not the only tool in the shed. We've trained over 3,000 people that have went through our course and are running some of these things. So I know there's at least 3,000 CPAs out there that know the good things to do. But if you're gonna take the first step, sit down with one of our CTPAs like Curtis, go through the due diligence with them, share with them what your goals and objectives are, and then they will work to identify, because Excel Empire is a multi-division company located in multiple locations around the country, that want to do what's in your best interest, because we realize you're living life the whole time. Right. And so if we put you in a strategy that requires you to dot the I's and cross the T's every year the exact same, that's not a good strategy for you, because life happens. And like I said, it's not always that phone call that relative needs money. It might be that opportunity where your daughter got accepted at a very prestigious university, and that's going to require a little bit more cash outlay than your plans had afforded. So you got to have that. You got to have that dynamic ability. So
this is probably too late. I was thinking about the current economic climate and potential changes to, the tax laws changed. So how do you feel about the big, beautiful bill for business owners? I think it's a great, from what I've read, it doesn't give as much to rich people as people think it does. It's really it rewards what I call the producers who create jobs.
It does. I really think, and again, this is not a political statement.
Right.
I really think the big, beautiful bill has done a good job of putting tax incentives in it. And I mean, we're an accounting firm, so we were paying very close attention through that. As a matter of fact, one of our former people was one of the IRS commissioners. So we pay attention to what's going on in Washington. The big, beautiful bill does a great job of creating tax incentives that stimulate the economy. There's always been, I tell everybody, there's always been incentives, because the people that write the tax code is not the IRS. They're the policemen. It's Congress. So they are always going to be incentivized, because they own business and they get supported by business people that own businesses, to create tax code that benefits business owners. So first and foremost, the current tax code and the tax code even before, it's always going to lean towards making a very so. But the big beautiful bill went very far in making some of those things permanent.
Mhm.
And I'll go back to the Biden administration in 2023. They created the Inflation Reduction Act. There were portions of that bill that the big beautiful bill didn't eliminate. They built on. Creating great opportunities for high W-2 earners to start what we call a launch box business, meaning I don't have to spend 750 hours to do a real estate, but I can leverage starting a side hustle and get great tax benefits. So I like the big beautiful bill. Do I think it's perfect? It was written by imperfect people, so I'm sure there's some things in there that we all would love and like and disagree with and sometimes even hate. But overall, I think it's a good economy stimulating bill from a tax perspective. You'll find very few accountants that are going to that naysay it.
Awesome. So my final question, if you had to give one principle to every family or entrepreneur should live by when it comes, I was going to say when it comes to taxes, but all successful people have principles, right? Of that. So you don't, Ray Dalio says, so that all successful people operate with principles. Otherwise you'd be experiencing stuff as it was the first time, right? So a way to live. So do you have any wisdom you can impart like that as we close out that you want to lay on our people?
I always tell people, I may not be good, but at least I'm slow. There's a lot of jokes made about people from West Virginia, and I are one. But no, it's a great question. For me personally, again, this life is short. There's great opportunities. There's great memories. There's great things that you can do to help build your community and help others around you, and especially your family. We all love those things. But again, this life is short. I would really focus on, what is it that really matters? Nobody ever died and says, I wish I would have worked a few more hours over, or nobody ever dies, man, I wish I would spend a little more time inside the air-conditioned house. And then, again, this might be a little bit more philosophical. Some people would say religious, but I believe we were created by a creator for a purpose, and just get to know that creator so that you know that your life is lived in light of that purpose, to glorify him. And so I would recommend, I love reading. I read a lot of books. I love writing, but there's the greatest book ever written was the Bible. So I would say, my word of advice, go to the Bible and find out what your purpose is, and then make sure that you meet that purpose, and then your life will be a success.
I love it, because everything else is a derivative of that. Okay, so all personal is a derivative of that. Yes, so. Yes, I'm with that. So, this was awesome. Matthew, thanks.
Well, thank you, Curtis. I've enjoyed it. You are. I've done a few of these over the years, and I appreciate the conversation. I like that very, very much. And again, I look forward to seeing you in October. I'm actually going to be in Dallas during that week. That is when the book Shift launches, which is the entrepreneurial mindset. So I look forward to seeing you there.
All right. So guys, I'm going to so what happens if you think, hey, am I overpaying the IRS and losing money to taxes? What's my number one wealth transfer? In the show notes, I'm going to put a quiz, like a assessment. And I want you to take that, and then we'll kind of see if you're ready to talk. We'll set up and make the introduction, and then we'll see which, depending on if you're working or you're a business owner, we can now, when Matthew's talking about the portals, we can pre-decide and then introduce you to the proper people. So look in the show notes and take our am I overpaying my tax assessment, and we look forward to helping you. Matthew Pearson, thank you so much, and for sharing your powerful insights with our audience today.
It's been a pleasure, Curtis. Thank you so much for having me on.
All right. Thank you. Go, guys. Go make it a great day. So before we wrap up, let me leave you with this. Your number one wealth transfer isn't interest, fees, or even lifestyle. It's taxes. And most people are giving away far more to the IRS than they need to. I mean, you need to pay what you're supposed to pay, but you don't have to leave a tip. So that's why I created a quick quiz that will help you see if you qualify for strategies to reduce your tax burden and keep more of your money working for you. It only takes a few minutes, and it could be the most valuable step you take this year. Just go to the link below, take the quiz, and find out if you're ready to take control of your cash flow and start living the money for life way.